Hi, everybody. First of all, myself and Carlos have been working together for the last couple of years on the Coalition for Climate Resilient Investment. We heard earlier this morning Alok Sharma saying that the insurance industry was out in force yesterday talking about resilient infrastructure. And I must say that the CCRI is truly an innovation from the insurance sector. It was an idea that was born from Willis Towers Watson and something that Carlos has championed for the last few years, not only providing leadership and innovation, but also really bringing the whole infrastructure together to create solutions for the public good and to advance investment in resilient infrastructure. So really pleased to be sharing the work that we've been doing with you today. So just to start by saying that there's been a lot of momentum over the recent years in adaptation and resilience. We've seen the private sector getting much more involved through the TCFD, the Task Force for Climate-Related Financial Disclosures, where there's a need to identify, manage and report on your climate risks, both physical climate risks and transition risks. Today, we're focused on those physical risks and how to embed those into our decision-making. But also at COP last year, we saw that adaptation and resilience was right at the top of the agenda. We saw it at the top of the Glasgow Pact, and there was so much of a focus on adaptation and resilience, and really the need for better data, information, and information so that investment can occur in resilience. But most recently, we also saw the publication last month of the Intergovernmental Panel on Climate Change report on adaptation and impacts. And that report, as always, threw out some real challenges to the world, highlighting that we are seeing irreversible impacts of climate change, that almost half of the population of the world are in places that are highly vulnerable to climate change. But also, one of the things that really struck a chord with me was the fact that the gap between the action that we're taking on adaptation and resilience and what's actually needed is growing as the climate changes. And so we need to evolve. We need to evolve our strategies around climate and climate change adaptation. But also, we need to think beyond the normal, and we need to think about things that we can do that are transformational, so things that we can do that can transform our infrastructure systems, as well as things we can do that are transformational at an asset level as well. So thinking about how we can systematically look at adaptation and resilience in everything we do. And so these are some of the challenges that I think the Coalition is really addressing well. So I'd like to hand over to Carlos just to introduce some of the work that we've been doing.
That's fantastic. And I can take it. Thank you so much. So Madeleine, first of all, thank you very much to you for the very kind words. Hello, everyone. A real pleasure to be with all of you today. Thanks for making the time for this session. As Madeleine said, my name is Carlos Sanchez. I'm the Executive Director of the Coalition for Climate Resilient Investment that I'm going to be describing a little bit to you. And it is true that we have achieved a level of momentum and delivery that we have worked very hard towards. But it's even more important to recognize is how many champions within the coalition, the 126 members representing 25 trillion in financial assets, how many champions we have. And it's really special to be with you today, Madeleine, because the last 2 years, Mott MacDonald has been simply incredible in dedicating pro bono time in a very, very passionate and committed way. And we owe a lot of where we are to many champions, but really a standalone goes to Mott MacDonald. So let me just walk you through the very genesis, motivation, and justification of this coalition. So as we know, and as Madeleine said, we all now recognize there is no debate anymore about the impact of climate change. We know that the maps look very scary. But what we are facing is the strong inability and inefficiency in the integration of these risks in decision-making. Let's put it very broadly, decision-making. But if we go a little bit deeper in more detail, you see how particularly investment decision-making struggles to understand the physics story, so the science. So how a 1 in 100 hazard today will be in years 5, 10, 15, and 20. Second, to interpret that, because as we all know here, physical climate risk is much more than loss and damage. We tend to simplify this discussion as, it's the impact, I need to repair, and then I keep going. But there is much more than that. There is a discussion about CapEx, OpEx, depreciation, market stability, your consumer ability, macro stability. There is so much that needs to be properly understood. So as a result of this difficulty with the science, as a result of this difficulty in the interpretation of financial materiality associated to this growing exposure to physical climate risk, we also see a problem with incentive structures and incredible and very promising developments and initiatives in the regulatory space, in the credit rating space. But as of today, we are not being able to fully neither enforce nor reward the right integration of physical climate risks, which really brings us to the real problem here. That is that as of today, it's not that we struggle to recognize and to integrate physical climate risk, is that in many instances it is penalized. Because you have on the one side of the equation, you may increase your CapEx by 1%, but that is not properly, fully, and efficiently recognized in terms of reduced OpEx, reduced CapEx, increased revenue, or improved credit quality. So that is really the genesis of CCRI, is to say there is a valuation risk. If things keep going as they are going, and that is good, that is regulation, rating, analytics, science, we're going to see a point in time in the next 2-3 years where this risk will be better understood. So what the quantum of our support are those actors that recognize that it is also an opportunity to really understand this. So with that genesis, we started working the coalition. We are also dissecting the case for resilience. So we feel that it is a little bit conflated currently, the understanding of resilience. There is the vulnerable communities, ecosystems, macroeconomics, and then you make it together with cash flow protection, dividends, and at the end you have a bag that speaks to many different constituents, but as one solution will not fit to all of them. So that's why we divided our work into different working groups, which essentially can be simplified to work with governments, so where we deliver solutions for a government to understand how a unit of fiscal capacity today will protect economic, social, and ecosystem value in that jurisdiction over the next 20 years. And then we work at the asset level, where the collaboration and championship of Mott MacDonald has been so crucial, where we are tackling the cash flow modeling component to this. So really looking entirely and exclusively at the risk-adjusted return dimension to all of this. And a point on collaboration. The coalition, it sounds it's maybe all asset owners, but it's a very good balance between pension funds, asset managers, banks, rating agencies, engineering, insurance, climate risk data providers, governments, multilaterals. And it's not that we like to have many people in the room, it's that each of them has one particular component and ingredient to the solution that is absolutely, absolutely crucial. So basically we have all of this. Financial innovation relates to the opportunity that we have for financial instruments to not only facilitate the raising of capital, but actually to bring and enforce and incentivize the right design and the right level of investment in a given asset. And all of these together, of which we are very proud that we are delivering in each and every piece that you see here, these three working groups, what we are seeing is that we are starting to get into capital mobilization, because our working thesis is proving true, and that is that different actors, be it governments, be it multilaterals, be it pension funds, be it asset managers, be it banks, are knocking the door to say, this speaks to my way of making decisions. So I can see my capital being supported in this. And that's where we are working on what we call the League of Investment Funds for Resilience, or LIFR, which is basically a series of investment vehicles that will commit to integrate these analytics for the origination, screening, and valuation of transactions. So really, really exciting. Just a quick snapshot into membership. So here you can see a little bit of the evolution, regional balance, industry, sector, and also in terms of assets represented. It's to be improved, and it is true that because we were born in the UK with the absolutely crucial support from the UK government ahead of the UN Secretary General's Climate Action Summit in 2019, so it has a little bit of a UK soul to it, but we are working hard to really have a proper diversification and balance across regions. So on this point about regional focus, it's also worth noting that our scope is global. Our priorities are in most vulnerable regions, so Global South, and accordingly we're working towards mobilizing capital. But this is a global discussion, and really down the road what we want to see and what we are seeing is a very direct and potential application in Global North, so US, UK, Europe are already expressing a lot of interest in bringing CCRI to those regions. So really remarkable where we are bringing, and again, more than the number, either in members or assets, and we just heard a reference to GFAN, so we cannot compete with that quantum of trillions. But what we are really proud is the commitment. We are not asking membership fees to members. We're asking for their time and their commitment, and they are proving, and Mott is the best example of that. They are really coming to work with us in a very, very committed and visionary way. So with that, and this is maybe to just wrap up before I hand back to Madeleine, what we are really seeing is that we are moving the narrative. The narrative initially is what you see on the left-hand side of your screen, and that is that you have a J-curve. So for a certain level of investment, you have a certain number of returns, you net present value that, and then you make a decision. The traditional perception on resilience is that you add a cost, ex ante, and then you don't see anything, or you see a very poor recognition of that. So you basically have a perfectly parallel J-curve underneath, which really leads to no rational investor will really go and opt for that. And that is the danger. The good news is that what you see on the right-hand side of your screens, which initially was theoretical, we are drawing that with our hands as we speak, because we have case studies. We have already 5 case studies in which we have been looking at the heart of the cash flow models with the fully working formulas, underlying assumptions, and working with an absolutely wonderful array of factors in adjusting each and every line in that cash flow. And what we are seeing is what you see on the right-hand side. That the increase in cost is not as relevant as you would expect. It can be more efficient. And our opinion is that with time, this will become more and more and more efficient. So that delta capex is just going to be reduced because of factor of rewards, incentives, and innovation. But what is most relevant is that then on the long run, the benefits really compensate for the cost early on. So to put it in other words, what resilient investment is perceived today, that is that tedious, kind of safeguarding process compliance, which is effectively rather unattractive, we are seeing that it's actually the best way to invest, and it's actually the best way to protect portfolios, assets, economies, and an ecosystem. So with that, I would love to bring back to Madeleine to speak about PCRAM. Thank you.
That's great. Thanks, Carlos. So yeah, when we came together to think about this challenge, about how we were going to work across the industry, I think it was quite clear to us from the outset that one of the challenges was how we communicate across our different professions. So we decided to work together using asset management, financial analysis, climate risk management, good practice, and try to come up with a methodology that was, really spoke to each of those, that all of those professions could understand, and we would try to find a unifying approach where we could all look at how to address physical climate risks in our assets. So the PCRAM methodology, the physical climate risk assessment methodology, is at its core essentially a climate risk assessment, but looking at those costs and benefits, as Carlos has already set out. It is the first time, I think, that anybody has gone with developed a method where you go from the climate change projection all the way through to the cash flow model and the quantification of benefits associated with the investment. So whilst we're using traditional methods to develop this guidance, actually the innovation is in how we bring all of that together into one place. So that's what we've set out as our challenge. So this is a very high-level summary of the method that we have been developing. There is a publication that sets it out in some detail, but the guidance is due in a few weeks and will be published. And as Carlos said, we've tested it on a number of case studies as well. So both new assets, existing assets across different sectors, and public, private, different types of case studies to really test out the method. So I mean, we can run through it very quickly, but effectively it should be quite a familiar approach that you're seeing here, where we first look at the data that's available to us, both in terms of asset data, climate data, and the financial data that we need to make an assessment. We then look at the materiality of climate risks for the asset and for the asset management objectives. So not necessarily just looking at profit, but also some of those other objectives around downtime, and the asset itself. And then obviously once we've identified where those critical risks are, we look at options for building resilience. And then moving on from there, we go into the last step, which is looking at different scenarios where you can build in different packages of options for resilience and what the impact would then be on the economic and financial modelling. I have to say, as I'm always reminded, this is a maturity building assessment. We do it before an investment decision, and we do it throughout the lifetime, and that reflects the fact that organisations will need to, evolve their thinking around how they manage their assets, but also the climate is constantly changing, and we need to keep updating this as we go. So I don't have any time left, so I'm just going to end by just showing you some of the publications that we've produced in the last year. Firstly, the risk and resilience paper that really sets out the challenge that the CCRI is trying to address. We do have a teaser published on the CCRI website as well of the PCRAM methodology. But I think it's really important to also highlight that this is really getting some traction around the world. We saw also last year that the state of California is endorsing the CCRI methods in the infrastructure reporting for infrastructure owners and operators in California under the TCFD. So that's really great progress. But also in the IPCC report last month, the CCRI has been highlighted as one of the key private sector initiatives in this space. I don't think we've got time for questions, Carlos. We soon ran out of time. Okay. Is there any?
No. Okay.
Thank you.
Thank you so much. Thank you, Madeleine.